Hello students, my name is Gakwiri Samuel, your lecturer of Advanced Financial Management. Yeah, uh, we are in a difficult period because of coronavirus. That is why we are locked down at home. But meanwhile, we can benefit from some occasions to continue our studies. What I can tell you now, I encourage you to make your effort in order to cope with the problem we have, all of us, because if you don't make any effort concerning your studies, you may fail, and this will be an obstacle to your development. But if you collaborate with the university, which is making all its best in order to help you, you will succeed. Maybe it may delay, but at the end of the day, you will not regret for the time, for how you have used your time. Let us now start our course titled Advanced Financial Management. I remember we have been together once. That is why I preferred to introduce the course if it is the first time to start. Yeah, let us now start. The course is Advanced Financial Management. When we say Advanced Financial Management, that means that there is financial management which is not advanced. Yeah, in the second year, you have learned about financial management. Actually, it is an introduction to financial management. This one is intermediate financial management, and maybe the one that you can consider as really advanced with the financial management that you are going to see at the master's level. Yeah, the prerequisite for this course is financial management, but also you must have some notions of statistics. You must also have some notions of mathematics and some notions of accounting, especially financial accounting. Whenever I start this course, I like to give a difference between financial management and financial accounting. You will realize that in most books, you find some notions of accounting mixed with some notions of financial management, which makes some people confuse financial management with financial accounting. But there are two quite different disciplines. An accountant records data in the journal. After a certain period, he must summarize all accounts in the ledger. After preparing the ledger, he must prepare the trial balance to classify accounts among balance sheet accounts and income statement accounts. Afterwards, he must prepare financial statements. Financial statements are the balance sheet, the income statement, the cash flow statement, and the retained earnings statement. Then this report, which is prepared most of the time at the end of the year, must be given to the financial manager. In different organizations, non-profit making organizations and profit-making organizations, you will realize that the supervisor of an accountant is a financial manager. Why? Because the financial manager must take these data made up of financial statements, analyze them along with the economic environment of the company in order to make decision about the future health of the company. So accounting is different from financial management because the accountant prepares financial statements and the financial statements are analyzed by the financial manager. The financial manager is a decision maker. That is why you will realize that the financial manager in different organizations is included in the top management. Within the top management is the manager. He manages funds of the company. Yeah, and the main objectives of a financial manager is to make financing and investment decisions. Yeah, he must make financing and investment decisions. Financing is different from investment. Investment consists of allocating funds, whereas financing means acquiring funds. Yeah, when, for instance, you make a decision of opening a project, that is an investment decision. But when you make a decision to borrow money in order to introduce that money in your project, that is a financing decision. So a financial manager must have sufficient skills in accounting, but he must also have sufficient skills in financial statements analysis. He must also know how to analyze the economic environment, what we call SWOT analysis, analyzing the strengths, weaknesses of the company, and the opportunities and threats outside the company. Then, after analyzing financial statements to know more deeply the financial position of a company, after analyzing its strengths and its weaknesses, after analyzing opportunities outside the company, after analyzing the threats like competitors, like the scarce number of customers, then he will make decision for the good health of the company in the future. And the future may be long, the future may be short. That is why he will have to prepare a strategic plan, which is a long-term plan. And on the basis of the strategic plan, you will have to prepare the operating plan, which also is called the business plan. And this is a short-term plan corresponding to 1 year. Let us now come to the introduction of our course. A financial manager must understand the role of stakeholders in order to anticipate the types of decisions that might be made in particular circumstances, and as non-financial objectives are at least as important as financial objectives and will have a significant impact on the three main financial management decisions, that is investment decision, financing decision, and dividend decision. Let us first talk about stakeholders. What do we call a stakeholder? A stakeholder is any individual, any individual or any people who has, or any organization which has a business a very close relationship with the company. Yeah, I can give you some of them, or even all of them. Customers, suppliers, creditors, owners, also called stockholders or shareholders, the government and the community, also the personnel, people who are working for the company. All of those are stakeholders. When you are a financial manager, you must understand the role of each stakeholder in the company, because in business there is you never get nothing for free. All of these stakeholders are remunerated. The remuneration of customers is good services. When you respect the contract with your customers, that is the remuneration to your customers. But also the quality of products, that is also a remuneration to customers. What is a remuneration? A remuneration is what you get in order to remain with the company. I'm not using scholars' definitions. In this course is a practical one. So when I say a remuneration, it is something you receive from the company in order to continue your relationships with the company. If you are respecting the contract of customers, if you are producing some products which have a very high quality, then customers will never leave you. If you are receiving them, you are receiving your customers fairly, your customers will remain with you. It is the same for suppliers. Suppliers are people who supply goods. Let me consider, for instance, raw material to conserve or to maintain the relationship with your suppliers. You must still respect their contract. Yeah, it means you must pay their money on time, and you must respect them. If you are dealing very well with your suppliers, they will never leave you. And we have, for instance, the personnel, workers and managers, employees. Those also are stakeholders, and their remuneration is salary. But it's not only salary, because you must also collaborate very friendly with your employees. They can leave you. You must care on the conditions of work. Those are different types of remuneration to your personnel. You must also consider creditors. Creditors are people who have lent money to the company. You must respect their contract, you must pay interest on time, and you must pay back the borrowed money on time. The respect is desired by all stakeholders. The government allows corporations to work in the country. So the regulations set by the government must be respected. If you are not working according to the government regulations, it will be difficult for you to succeed in your business. Not only you have to respect those regulations, but you must also remember to pay tax and fairly. You You must calculate fairly your tax and pay tax to the government. The community. What do we consider as being the general community? People who are surrounding your company represent the community. And there is no specific remuneration to the community, but whenever the company is working with performance, when it has a very high performance, then that is a remuneration to the community. I can give you a very simple example. People who are cleaning the university, let us be in the campus of Huye, those people are people who are living in the surrounding environment of the campus. Meanwhile, they are benefiting from the existence of the University of Rwanda. Others have built some restaurants because there are many students who are studying in that campus. If you consider Sebukangaga, who has a hotel, some lecturers are being they occupy the hotel. Even some other lodges surrounding the university, that represents the remuneration to the community. So when you are a business manager, the financial manager of a company, you must understand the role of stakeholders, and you must anticipate all of those types, the decisions that you must make in order to satisfy all of these stakeholders. Yeah, that's why you must also have some non-financial objectives. When I say non-financial objective, it is an objective which will not necessarily provide the company with money. Like when you are helping some community, services to the community, you are not getting money, but you are paying money. You can be paying money. By paying money, this will not increase your profit. It may even reduce your profit in short term. But in the long run, you will realize that your profit has increased, has been magnified, because you accepted to pay some amounts of money. Those are non-financial objectives, which are also very important for the success of the company. The principal role of the senior financial executive when setting financial goals is the maximization of shareholders' wealth, which is equivalent to maximization of the market value of the company's ordinary shares. Yeah, I want to remind you something. Some people think that the goal of the company is to maximize profit, which is not true. You can maximize profit today, but if you don't go deep in your analysis, you will realize that by maximizing profit today, you can be minimizing profit in the future. So, what is important is not the maximization of profit today, but the sustainability of the company. When I say sustainability, this means that your company will be performant all the time for infinite time. Whereas people die, the company should not die. I can give you an example of Bralirwa. Heineken is the owner of Bralirwa and other beverage beverage manufacturing companies around the world. The owner is Heineken. He has passed away and he was replaced by her daughter. I don't know whether today she's still alive. But meanwhile, the company did not die. The daughter of Heineken may even die, but the company will last. So, the sustainability of a company, that's the main objective of the financial manager. But please remember, this will not be sustained if it's not performant enough. So maximizing shareholders' wealth means succeeding to increase year after year the performance of the company. When I say performance, it does not mean maximization of profit. It is the achievement of all objectives of the company. And if all of these objectives are achieved, the profit will be good for a long run period. And by making your company as performant as possible, you are maximizing shareholders' wealth. How? What is the wealth of shareholders? The wealth of shareholders is not only dividends, because even the company belongs to them. So maximizing shareholders' wealth consists of maximizing retained earnings and also paying regularly dividend. This is equivalent to the maximization of the market value of the company's ordinary shares. The market value of the company's ordinary shares are also called common shares. Yeah, in Kinyarwanda we say akeza karigura. When a company is performant enough, its share, especially its ordinary or common share, is expensive on the financial market. On the capital market, it is expensive. When your company is very weak, the share of this issued by the company will be cheap. Why? Because people will not be willing to invest in your company. So, as a financial manager, you must do your best to maximize shareholders' wealth, to make your company be as performant as possible, so that the market value of the company's ordinary share will be expensive. A company is financed by ordinary shareholders, preference or preferred shareholders, long stockholders, and other long-term and short-term payables. Yeah, this is known. The capital of the company is made up of ordinary shares, preference shares, and bonds or other long-term borrowing from the bank and short-term payables. When I say payables, those are suppliers who have sold you their material or on credit. All surplus funds, however, belong to the legal owners of the company, its ordinary equity shareholders. Any returned profit are undistributed wealth of these equity shareholders. This explains what I told you. I told you that increasing shareholders' wealth consists of increasing the owner's property. And the owner's property is the company itself and dividends, common dividends. So the financial manager should do its best in order to increase shareholders' wealth. Yeah, the principal financial objective of a company. Yeah, in seeking to attain the financial objectives of the organization or enterprise, a financial manager has to make three fundamental decisions: investment decision, financing decision, and dividend. Let us start first by, I will come back to this. The investment decision involves selecting appropriate investment opportunities that will help to fulfill the company's primary objectives. Yeah, remember, the primary objectives or objective of the financial manager is to maximize shareholders' wealth. Through the investment decision, the financing decision, and the dividend decision. Let us start by investment decision. Investment decision consists of selecting among different investment alternatives, different projects. Yeah, I want to remind you that when you make a decision to invest, you look at the most profitable project possible. You want to invest in the project which will provide you with the highest profit possible. Yeah, so you look at the profit. That is why in financial management you have learned about different capital budgeting techniques like NPV, like internal rate of return, like profitability index, like the profitability, the payback period profitability index. Those are techniques which show whether your profit will be high. That's the one you want to make an investment decision. You look at the profit. But when you are making a financing decision, you look at the cost of capital. Cost of capital is what you pay in order to get capital. Like one who wants to get a loan from the bank, he considers the level of interest he will be paying. When you want to make an investment decision, you look at the profit with the purpose to get the highest profit possible. But when you want to finance, you look at the cost of capital with the purpose to get a financing or funds with the lowest cost of capital. Like an interest, if you want to borrow from Beka or from I&M Bank, you will consider a bank which is requiring the lowest interest possible. And you are going to borrow where you will be paying a low interest. Yeah, we have different dividend policies. The dividend payment decision depends on the strength of the company. If the company is strong enough, it will be paying a regular dividend, a very high regular dividend. But if your company is not strong enough, the policy will have some flexibilities, saying, for instance, that there is a very small amount that shareholders will be getting regularly, and if the company produces a high profit, then dividends will be high. It means that you are going to add a certain amount. In some other corporations, they consider a percent. Whatever the profit got, you can say, for instance, that shareholders will be getting 10% of net profit. Yeah, so all of these decisions, investment decision, financing decision, and dividend decision will be made on the basis of the different financial situations of the company. The three fundamental decisions interconnected that support the objective of maximizing shareholders' wealth are investment decision, financing decision, and dividend decision. The principal financial objective of a company is continued. Underpinning these decisions is the management of risk, including the management of exchange rates and interest rates. What is the risk? What is the risk? An accident is not a risk. A sickness is not a risk. Like coronavirus is not a risk. What is the risk? Risk is the probability to get an unexpected outcome. You were expecting to succeed, but there is a possibility for you to fail. That possibility to fail, that is what we call risk. Failure is not a risk, but the possibility to fail represents a risk. We talk about risk when there is uncertainty. I don't know whether it is raining or not. But if I have skills to measure the probabilities for raining, then there is a risk of rain. Now among these types of risk, we have the exchange rate risk and interest rate risk. When I say exchange rate risk, exchange rates is among different currencies, foreign currencies, like one in France compared to the USA dollar. There is an exchange rate risk because exchange rates are not stable. Sometimes they may increase, some other times they may decrease. If I am expecting to buy using dollar and the exchange rates increase so that I will be paying much in order to get a dollar. So there is a risk for me to buy very expensive, and when you buy very expensive, you are losing. If I want to sell, to buy, my wish is that the exchange rates falls. If I want to sell, my wish is that the exchange rates increase. Interest rates may decrease or increase. This depends on the inflation phenomenon. When there is an inflation, it means that you have much money, and the interest rates will increase. Interest rates increase when there is an inflation rate, when the inflation rate increases. But also, there is what we call real rate. Real rate is fixed by specialists. Now, when you want to borrow money and the interest rates increase, there is a risk for you to fail because you will be paying much. So, risks also must be taken into consideration in decision making, in financing, investment, and dividend payment decisions. You must take into consideration different types of business risk. At the same time, financial managers must monitor the company's financial position and plan for situations where cash injections may be needed. Now the company financial position, remember, is represented by the balance sheet. But it's not sufficient. You must also have the cash flow statement in order to know the origin and the destination of funds. Now you can know whether you need to inject some cash by borrowing, and it will be costly. Yeah, so all of these are factors which affect the investment, financing, and financing decisions, and dividend payment decisions. Control of how the money is used is also important. The funds are being used on behalf of the shareholders. Yeah, that's why you have said that the cash flow statement is very important. At all times, the financial managers should remember that they are making decisions with a view to increase shareholders' wealth. Yeah, the main objective, whatever you do, whatever decision you make, must remember that your main objective is to increase shareholders' wealth. It follows that all stakeholders, internal and external, should be kept informed of financial policy and corporate goals through effective communication channels. Yeah. Now, when you are making a decision, when you are making any decision in the company, you should know how to communicate your decisions to stakeholders. Measurement of stakeholders' wealth. Yeah. Remember, if you are doing everything in order to maximize shareholders' wealth, you must know how you measure stakeholders' wealth. In order to measure shareholders' wealth, you must be able to measure the value of the company and its shares. How do we do this? Remember, we have said that the shareholders' wealth is measured by the company value of common equity, of common shares. So, by measuring the stakeholders' wealth, we must measure the value of shares. Statement of financial position valuation. Remember, the statement of financial position is the balance sheet. Assets will be valued on an ongoing concern basis. If retained profits increase year on year, then the company is a profitable one. Statement of financial position values are not a measure of market value. Although retained profit may give some indication of the level of dividends that could be paid to shareholders. We distinguish between going concern, a going concern, and basis and breakup basis. Maybe to explain these two different notions, let me consider someone who wants to buy a cow, not a car but a cow. Yeah, I can have different purposes to buy a cow. I can buy a cow in order to get meat. But also I can buy a cow with the objective to nurture the cow and to have from it many cows. If I want to buy a cow with the purpose to get many other cows, I'm an investor and I want to get many cows from one cow. So my judgment, my decision, when I'm buying a cow, I don't consider the size of the cow, but I consider the reproduction. If this cow, according to the history of its ancestors, is a productive one, that is what I call going concern basis. If I want to buy a company, let me consider, for instance, the acquisition of a company with the objective to continue my activities. I consider the company as a going concern. But when I want to buy a car for meat, I consider the quantity of meat, how consistent its body is,